There we go. Thanks, Robin.
Okay. Do you need me to stay at the podium, or can I go over to the screens to point at things? Yeah, the camera will move. Great. Sorry about that. Well, thanks for the introduction. I like to rove around the stage. I get bored sitting at a podium. But I'm going to talk a bit about my trust, or the trust I run with my colleague, King Fui. As mentioned, we took over the trust in March 2013, so it's just past its 10-year anniversary. A lot of what I'm going to say actually does dovetail or actually overlaps a little bit with what Ed's saying, which is good news because there's 30 charts in this deck. My colleagues have said there's no way I can get through it in 30 minutes, but I do talk quite fast, so you'll have to concentrate, and you certainly have to concentrate to get through, because they're quite packed charts, which is why I'll talk through them quite quickly. So I've been managing Asian equities for almost 35 years, and I used to do press. I'm not here to sell you anything. There's an open-end version of my fund that's closed, so I don't do sales pitches. What I'm hopefully do here is make you think about Asian equities as an asset class, how much money you want to have in Asian equities, should you have a big structural overweight. In the past, the dim and distant days, the 1990s, when Asian equities were doing really well, I used to do lots of pitches doing sales things, and I look back with hindsight 30 years on of what I used to say then, and most of it was complete garbage. And which is also why you don't want to own an Asian ETF unless you think you're some brilliant tactical asset allocator. You certainly don't want to buy and hold one. So reasons not to have loads and loads of money in an Asian ETF or a massive structural overweight in Asian equities. Demographics is destiny. That's one I used to always say. Like, lots of young people, hardworking people, it's going to be great. Obviously, MSCI Pakistan, I think, it's done even worse than the MSCI China. Nigeria, a complete disaster. Actually, Korea, Taiwan, Singapore, Hong Kong equities do pretty well, and the demographics in all those countries is pretty diabolical. So demographics is not a reason to buy any emerging market. Obviously, Ed touched upon this. Strong GDP growth equals stock market returns. I'm afraid it doesn't. Some stock markets it does, some it doesn't. We've talked about China. I actually run my series from November 1992, which is when I actually first went out to Hong Kong. I spent most of my career in Hong Kong. I returned about 5 years ago. I had all my hair then. I was full of optimism. Rah, rah, rah. Everything was going to be great. So, as Ed highlighted, China is actually down since 1992. It's actually down about 40% since 92 because the index was launched then at 100 and it's 60 today. If you wanted to really match Chinese GDP growth, I think we all now know this, you wanted to own Louis Vuitton. That's absolutely almost perfectly matched Chinese GDP, and that's because where has Chinese growth gone to? It's gone to a very small selection of really quite rich Chinese people who've then bought handbags and drunk champagne. So why? You also don't want to own an Asian ETF. I used to do all this one, the rise of the Asian middle class. I used to wander around and tell everyone, think about 1.3 billion people in China. They're all going to buy deodorant, 2.6 billion armpits. It's going to be great. Unfortunately, that's not what's in the Asian index. The Asian index, again, Ed highlighted this. There's a lot of state-owned enterprises who allocate capital badly. That's not just in China, that's in Thailand, India, elsewhere. For the trust, we don't buy state-owned enterprises. I'm old enough to remember the 1970s in the UK and British Steel, British Leyland, and it's always tainted. That's been one of the most successful things in my career is never owning SOEs. It's been a constant throughout, based on the experience of brownouts and power cuts in the UK in the 1970s. Anyway, what's in the actual Asian index? Lots of banks and real estate, as I've said, some SOEs, some good banks, some bad banks. Lots of global cyclicals. About half the index is actually global cyclicals. Good global cyclicals like TSMC, bad global cyclicals like Sinopec. Domestic demand is actually quite a small part of the index. It's about 25, 30%. So not surprisingly, if an index weighted like that, this is the MSCI AC Asia ex-Japan, so the most commonly used Asian index, it actually correlates with the MSCI World again, as Ed was sort of highlighting. It's actually a more volatile version of the MSCI AC World. So again, if you're thinking for your clients how much to have in Asia, Asian markets probably are reasonably cheap at the moment, but do you want a massive structural allocation based on rising Asian middle classes? No, you don't actually. certainly not an ETF. Now, why you might want to own an active equity fund, obviously I would say this. There are markets in Asia that do quite well. Best performing market in Asia going back to 1992 is the one that all the Asian investors normally hate, the MSCI Australia. By far and away the best performing market in US dollars. Australian companies allocate capital well, pay dividends, and the Australian dollar's actually done reasonably well too. Most emerging market currencies devalue. India has done quite well, particularly obviously recently, whereas there's obviously markets, not just China, that don't do well. Malaysia's been miserable too. But there are stock markets in Asia that are good, which is why you want to have an active manager. Other reasons to have an active manager, again, talking my own book, ETFs actually underperform quite materially in Asia because they have fees, obviously, but also because there's implementation costs. It's actually quite expensive to trade in Asia, both when you have portfolio impact and just the costs of dealing itself. Whereas most active Asian managers do outperform. I've got the trust there on the right-hand side. Since we took it on, it's 80% above the index, or 80 points above the index. I'll go on to talk about performance later. So what do we actually do for the trust? How do we take advantage of the fact you do want to be active in Asia? So the first thing I always say, and I say this, I used to manage the Schroder's team in Asia. I was at the head of the team for about 15 years. Ignore the index. The index is not a good representation of why you invest in Asia. And hopefully Ed's presentation also highlighted that. Where a stock is listed is unimportant. It's what a company does that's important. Focus solely on absolute returns. Everything we buy for the fund, we buy because we think it's going to make us money, which might sound a bit odd because you go, don't all fund managers do that? No, quite a lot of fund managers own stocks because they're a large part of the index. I must own some TSMC. I must own some Chinese banks. No, I only want to own stocks that have upside to our analysts' fair value, are buy-weighted, and our analyst has given me conviction that it's worth owning. So typically you own the 50 best ideas coming from our research team. Schroders is one of the biggest investors in Asia. There's pros and cons of being big, but one of the good things about being big is we do have 50 investors for me to draw off, so I can really focus on those analysts I think are our best analysts and get their best ideas. And then lastly for us, top-down, which makes the trust a little bit different from most of our peers, we don't do asset allocation. We look at risk, obviously, and how much is the maximum you want to have in one sector or country, but we don't asset allocate using widely available pieces of information like, oh, I think interest rates are going down in China, let's buy China. I think politics are improving in Korea, let's buy Korea. We never do that. I've tried to do that in the 1990s and it was a disaster, it doesn't work. 10 fund managers sitting around talking about what they've read in the FT or the Asia Wall Street Journal the day before is utterly pointless. Markets are relatively efficient. What we do instead, my colleague King Fui, who I run the trust with, his background is econometrics and statistics. He runs a series of different models looking at past trading patterns of markets in Asia to decide how much beta to take and where there are risks should we take money off the table. I won't talk about them in detail in the interests of time, but here's a summary of the process and how we're positioned today. So step one, stock selection. We're fully invested, slightly geared at the moment, 4% geared. We've got about 60 stocks. If you look at the difference between the trust and the open-ended version of this fund, the trust for me is much more fun to run because we can use gearing. We use the models to help us determine how much gearing we use. And we also, because it's 1/10 the size of the open-ended fund, we can buy quite a lot of mid and small caps that we can't buy for the open-ended fund. And the trust is outperforming its open-ended equivalent by about 1 to 2% per annum over the last 10 years. So accumulated over 10 years, quite material. In terms of what our models are telling us, we have two sets of main models we use to determine how much risk to take in the fund or whether we want to be relatively bullish. The country models look at 1 to 2 years. They're based on Campbell and Schiller around mean reversion to standard valuation metrics. We believe markets do mean revert. What King Fui's done is adjusted them for business cycles to say at this point in the business cycle, what typically does this stock market trade at, and what would the move be to be at that typical average trading point. So it gives us a forecast return for each of the major Asian stock markets. At the moment, those models are pretty much neutral. They're not telling us markets are blindingly cheap. Equally well, they're not telling us they're expensive. Asia looks pretty much fair value to us at the current point. Our tactical model is much more short term. It looks out 3 to 6 months. So it looks at measures of economic surprise indices, sentiment, measures of financial distress, inflationary expectations. When this was run, when I prepared the presentation at the end of May, those models were still neutral to positive. They were very positive at the end of last year, actually, when markets in Asia were very, very weak and sentiment was bad. Obviously, we had a big rebound when China reopening, the models turned to neutral. And as at the beginning of this month, they've actually turned neutral to negative. So they're giving us a relatively cautious reading, which a little is picking up the same as what Ed was talking about earlier. Our economic surprise indices have turned down. It does look more risky that, US recession worries are still out there. Markets definitely look a little bit complacent. So what we've been doing, particularly as the AI frenzy has built up, and that's obviously pulled into some of the Asian tech sectors, we have been buying some puts on the Korean index to provide a degree of capital preservation on the fund. The fund was actually 115% geared at the beginning of the year. We've taken gearing down to 4%. So what we're aiming to do here, and that's one of the strategies of the fund, Asian markets are volatile, to say where there's clear signs of risk, to buy some puts, sell some index futures, raise some cash. So the strategy is relatively what we would call beta flexible. It's not just a straight plain vanilla strategy where we're trying to beat an index. In terms of how we're positioned today, so apologies, you won't be able to read this, but because it's obviously too small, but Hong Kong, China is around about 20% of the fund. We actually have a reasonable amount in Hong Kong. That's where we see the value. No one likes Hong Kong stocks at the moment. We've only got 5 or 6% in China. I'll come on to touch on our thoughts on China, which I'm afraid are quite similar to Ed's. Elsewhere, I'd say the fund's actually, in my view, it's very nicely balanced. We have about 16% in Australia, 15% in India. There's about 10% in Singapore. Taiwan's 25%. That's probably the biggest, certainly versus the benchmark, the biggest overweight. China's the biggest underweight. And we're reasonably still well weighted in tech. ASEAN markets, we have around about 20% as well, including a small amount in Vietnam, where we'd like to have a little bit more. So I'm looking forward to hearing from Dominic after me. But anyway, it's balanced across. And so it goes back to the fact we're picking things on a more absolute basis. Hong Kong, China together are close to 35-40% of the index, if we wanted to use the index. So we're massively underweight, but I think 20% is more than enough to have in Hong Kong and China, as I'll come on to talk about. In terms of performance, now it's an important chart for those of you thinking of buying investment trusts. So as I mentioned, the trust has done reasonably well against the index. We're doing 9.1% per annum in terms of the NAV against the reference benchmark that's 5.5. So I always say to investors, a reasonable expectation from Asian equities over the long term is to expect high single-digit returns, of which you should expect more than half of that to come from dividends. A lot of the countries I invest in, Singapore, Hong Kong, Australia, a lot of the companies pay attractive dividends, but they're relatively low growth, but relatively low volatility, so actually have quite an attractive profile from a total return basis, which is why the fund's partly called total return. What's interesting, though, and again, looking at investment trusts, I would say my universe is actually quite a good universe. The average investment trust is doing almost 8% per annum, so we're only a little bit ahead of the average investment trust. Nearly all the Asian investment trusts are outperforming their benchmark, which is why you want to buy an active fund. And actually, you've got the average open-ended fund here. It is ahead of the index, but significantly less than the investment trust. So, I think our universe we sit in, there's some very interesting funds. There's Baillie Gifford with a much more growth-orientated fund. There's the income funds, which I think are attractive, which my colleague Richard Sennett runs one of. So there's quite an interesting universe for you to look within, and I think the boards of directors, actually do a pretty good job. So the numbers are there. I'll skip past that. So let's talk a little bit about China and the tyranny of benchmarks. So our fund's very underweight China versus the benchmark, as I said, and I always get brokers and colleagues coming up to me going, aren't you worried you're so underweight? Everyone's underweight China. I have no idea if everyone's underweight China or not. Obviously, sentiment's not great, so I suspect maybe versus the benchmark, people are underweight China. But one thing I do know, over 5 years, $220 billion has gone into Chinese equities, funded out of, unfortunately, the bits are missing here, that's Korea and that's Taiwan, primarily funded out of Korea, Taiwan, and the rest of the ASEAN markets India's actually, that one there, has hardly seen any net inflows, even though everyone thinks all the money's gone into India. So versus 5 or 10 years ago, investors have a lot more money in China, and bonds are even more spectacular in this than they did 5 or 10 years ago. If you take a step back, knowing everything you know today, would you have more money in China versus 5 years ago? Knowing what you know about President Xi, knowing what we know about geopolitics, knowing what we know about friendships without limits? No, you wouldn't, actually. So the problem is MSCI has been ramping up the Chinese weightings. There's been a lot of equity issuance in China. They keep changing their free float factors. So even though China's been by far now the worst performing stock market in Asia, its actual weighting in my benchmark has gone up very, very substantially. So as Ed said earlier, it's unhelpful, to be honest, for my asset class. The best performing market in my asset class, Australia, has actually seen the biggest shrinkage because Australian companies buy back shares and you don't have permanent equity issuance. So this is why we need to get away from indices. Why has China done quite so poorly? Just to highlight some really similar charts from earlier. China is not short of capital stock. It's got huge capital stock versus its GDP per capita, much higher than Korea, Taiwan, or Japan at the same stage of development. And what's been happening here, and this is the key chart, your ICOR, your capital output ratio, or return on invested capital, would be the other way of proxying it. It's gone up massively. So China's plowing a lot more capital into their economy and getting a much less productive output. What do stock markets really reflect? Not GDP growth, return on invested capital. If you think about stock market, I give someone capital. How they invest that capital, what they do with that capital is what's reflected in the share price. That's why China doesn't do well. It allocates capital arguably very poorly, and that's why you get this really pretty awful trend. A-shares are a little bit better than the MSCI China. This is the chart on the right-hand side. The problem with A-shares, there's GDP in China, the green line. That's listed net income for the A-shares. It actually does track GDP quite well. But because A-shares are permanently issuing new shares to build more capacity, do whatever they do with it, you actually get really very poor EPS. So you just get diluted. And of course, as they issue more EPS, the weighting in the China index goes up ever higher. It's almost like it's a game for the Chinese authorities to suck more capital, our capital, into China to build out, the target industries from President Xi. It might work for Chinese growth. It doesn't work for stock market investors. And I don't really think that's changing, which doesn't mean China's uninvestable, but it means you have to be very selective in what you want to invest in. So going back to the economy, same chart as before. The only bit that's doing well is services. The big debate in China, and we're having this internally at Schroders, is really this one here. That's green bar is, that's labor compensation as a percentage of GDP in China. It's about 55%, same as it is in US, Japan, and Korea. What's different in China is household consumption as a percentage of GDPs well below labor compensation. People save lots in China. Japan and Korea, they match up. US spends more. What we can think about, the great hope for China is that you're going to see this consumer boom. People will stop saving lots and lots, and the consumption grows, and that's why you own lots of Chinese consumption stocks. As it stands today, I'm starting to question whether this is really going to happen. And it seems to me there's quite a structural reason why household consumption and labor consumption do not correlate in China. So this is the income you get from assets in China. That's the US. US people get lots of income from their assets. Chinese people don't. They keep cutting deposit rates in China. The bulk of Chinese savings, or half of Chinese savings, are on deposit. So you get nothing on deposit. Rest of Chinese savings in the stock market, obviously we know that hasn't done well. And then a lot of the rest of the Chinese savings is in property. And Chinese people don't rent out their flats. They hold them for investment. There is costs for holding a property. There's not property tax in China, but there's going to be service charges, upkeep, whatever else, even if it's an empty flat. It's an empty flat, you're getting no income for it. Chinese home ownership's over 100% because so many people have multiple properties. I think this is a permanent drag on consumption. And on top of that, in China, you have what everyone in China calls 4-to-1. So if you're a 20-year-old in China, you've got 2 parents, possibly 4 grandparents. There isn't much of a social net in China. So you don't feel that great about life if you're the one, because you've got to save money to pay for your grandparents and possibly your parents. So there's quite a lot of structural reasons why, if you're hearing one of those bulls in China telling you this is going to boom, I would question that it's ever really going to get anything up to the levels in Korea and Japan. Property we've talked about, or Ed's talked about, exactly the same page. It's an L at best. Remember, it was a property bubble we had from 15 to 20. There's absolutely no reason to think that comes back. Demographics alone would tell you that. Huge accumulated backlog of property waiting to be completed. Home ownership's over 100%. 70% of millennials in China already own their own home versus 30% in the UK and 35% in the US. There isn't huge pent-up demand for property. So at best, it flatlines, could be worse. To me, this looks, I used to do Japan as well as Asia. It looks so similar to Japan circa 1992, 93. The demographics in China are actually worse than Japan at that time. E-commerce, we don't like e-commerce names. I have zero exposure. I do have some Tencent, but we don't like e-commerce. It's fully penetrated and the economy is slow. And there's loads and loads of competition still in this space. It hasn't consolidated. Douyin, which is TikTok in China, is super aggressive in taking market share. So I think JD and Alibaba are probably value traps. So, having depressed you on China, let's talk about something else in the last 10 minutes. We're actually quite optimistic on the rest of Asia, so from an investment perspective. When to buy Asian equities? Again, sorry, there's too much. I was hoping we were going to have a nice big massive screen, but you buy Asian equities typically when the US is coming out of recession. So if you think the US is going into recession, there's no rush to buy Asian equities. But if the US goes into recession and you see glimmers of recovery, that's when you get the delta from Asian emerging market equities. So in the meantime, equities, as I said, don't look particularly expensive. And actually, we are getting paid to wait. So that's a dividend yield. It's actually emerging markets, which is 85% Asia versus developed markets. There's some great yields out there. So an Asian income fund, if you're feeling a bit more cautious, actually looks not a bad place to be. Then maybe you switch into a more growthy Asian fund, depending how you're viewing recession risks. In terms of valuations, at the end of last year, this is the charts we actually use for deploying gearing on the trust. When we're one standard deviation cheap on our top-down and bottom-up valuation indicators, we put on gearing. We did hit that point October, November last year during the NPC when everyone was panicking about China and everything else. The indicators then moved back down to pretty much where they are now in March, and we've taken off the gearing. So the moment we're looking at these indicators, where the red dots are, we're sort of slightly cheap, but neutral to slightly cheap. There's not a huge, obvious undervaluation versus its own history in Asia. Obviously, if you look versus US equities, you can make a different argument, but that's not my job. In terms of things we actually like, I think one of the speakers after me is going to talk about semiconductors, so I won't dwell on this, but we are overweight semiconductors. At this point, I certainly wouldn't be chasing because some of them have been frothed up on AI hype, but the real story for these stocks is you buy them when inventories are falling and their earnings are terrible, classic cyclical companies. This is DRAM stocks in Korea. That's your production numbers being slashed and inventories are finally falling. So we're quite happy holding the stocks and being overweight because we do think we're finally clearing through the inventory cycle. End of this year, we should be in a much more better position for 2024. And there was a lot of inventory built up. What we don't like in the semiconductor space, we really don't like Chinese semiconductor companies. This is the inventories in Taiwan, US, and Korea, which are actually pretty normal. They're adjusting. That's Taiwan Foundry, so that's TSMC, UMC, and Vanguard principally. They're about 100 days, which is a little bit elevated, but not hugely out of sync. Chinese foundry inventories have gone from 100 to 250, which goes back to that thing in China, capital is allocated badly. And in a country where capital's priced correctly, you don't run 250 days inventory because it costs money. You bring it back down. That's what happens in places like Australia, which is the most capitalist of the Asian countries, or stock markets. Even worse, Chinese fabless design houses, so that's semiconductor designers. Taiwan, US ones look a little bit elevated. That's the lines there. They do need to adjust their inventory still. Normally run about 80 or 3 months. They're running about 4 months. But China's running 1 year inventories in its semiconductor space, so churning things out. So I'm not quite sure what's happening here, but it just doesn't look good. And we see this replicated across quite a lot of sexy industries in China. Wind, batteries, solar, all the ones that all your ESG funds are loaded up with. The problem is there's not huge barriers to entry in those industries and what there is in China, because anything, I would say, as soon as President Xi says, made in China 2025, it's our priority industry, sell everything, because it means you're going to flood it with capital. So those are the strategic priority industries. They're the ones you don't want to invest in long term, in my view. We also like Ed, we like banks for exactly the same reasons. For Indonesia, India, Philippines, because you are in that financialization curve where the key is that the governments have put in the correct infrastructure, better roads, mobile phones, digital networks, which is exactly what's happening in Indonesia and India. Hopefully the Philippines, it's definitely a step behind. But once you've got a mobile phone and a banking app, you can actually start transacting. And that's what moves you from lower income to lower middle income or middle income. And financialization is part of that. And good, well-run private sector banks are one of the best plays on that. We also like companies like Wilcon in the Philippines. It's basically Home Depot Philippines. What Wilcon's done very well, it's still a relatively fragmented market, DIY in the Philippines. Philippines got a very young population, does need to build a lot of houses, unlike China. But what Wilcon's done well is it's got all its own brands. Most Filipinos don't realize these are house brands because they've given them European sounding names. They source them from China. Gives it a much higher profitability ratio than their competitors, both GPM and EBITDA. So it means the cash flow, you can roll out your stores more aggressively and then dominate the segment. You've created your moat effectively. So that's the kind of business we're looking for in Asia, and that's what we spend our time trying to search. It's one that actually has a moat, you know, in a not ruthlessly competitive market. Philippines DIY is not ruthlessly competitive. ResMed in Australia, there's lots of interesting stocks in Australia. Australia's got a great cluster in healthcare. CSL, if you had a vaccine in the UK, it's almost certainly was a CSL flu vaccine, not COVID vaccine. There's also companies like Cochlear, ResMed, and what we're looking for here, other kinds of stocks we look for, is stocks that are in a market that's got structural growth. So what ResMed does is diagnose sleep apnea. So sleep apnea is very badly diagnosed, not normally diagnosed at all, but the market's growing. Sleepiness is an increasing problem, aging populations, etc. But what you've also got is better technology, sensors, semiconductors, whatever, to do online diagnosis, do all your monitoring, and really treat sleep apnea properly. So that's basically your market with growth because the market itself's growing, but growth because actually technology is improving the ability to treat it. It's number one in the world now on in the segment. I think Philips, its main competitor, had a product recall or something. I'm not an expert on it. We do like Macau gaming. That's one of the things we do agree with Ed. The one bit in China, we do see more of reopening. We do see travel coming back. Interesting, we have a big team in Shanghai. It's interesting at the moment. Because of Chinese firewalls and there's no free information flows, expert networks are shut down. There's, you know, it's almost like President Xi doesn't seem to understand that if you don't give me access to information in China, I'm not really going to invest there because I don't know what I'm investing in. But one of the things my colleagues were actually saying in China at the moment, they're bombarded with messages on Chinese media how it's safe to go to Hong Kong and Macau. They're good places to go to. Thailand's dangerous. Indonesia's dangerous, don't go to Europe, blah, blah, blah. And then the Chinese government doesn't give out visas to let people go to Europe. Obviously, you can't go to the US anyway. So I think travel will rebound in China, but it's going to be very spotty. So it's been disappointing, the tourism rebound in Thailand. Whereas Macau, going to casinos, that seems to be approved by the authorities, seems to be having quite a nice pickup. So that's the numbers on the charts here. Last couple of comments on India. India looks good. We've talked about it in the banks. Lots of digital transactions. Mr. Modi, I guess, gives any of us that are normal, liberal, Western people a bit of the creeps, for want of a better word. But one thing he has done is deliver a better ingredients for growth. Most of Indians now have a mobile phone. He's improved the roads, put in bankruptcy laws, cut through a lot of red tape and stupid legislation. So India definitely does genuinely appear to be on a path for a stronger GDP growth, because you managed to take out, imagine if you're a farmer in India, formerly 10 years ago, you didn't have a mobile phone, the roads were terrible, your onions are sitting there, you try and get them down, half of them rot in the way, you're reliant on a middleman in the market, to give you what could or might not be the right price for your onions, and then the money has to come back via physical notes. Now you can check on your phone what the price should be. The road's much better, so you can get your onions to market much quicker, and you can do the transaction on your banking app. So you've taken out all those layers of corruption and red tape that didn't need to be there before. Same for government transfers, where the government does its direct transfers to the poorer income segments. It used to go to a village chief, who would then steal half of it. Now you can do it directly to the person because everyone's got a digital ID in India. And 90% of people, I think, of adults now have a digital bank account. So quite a big change from 10 years ago. Problem is the stock market's super expensive. So we do have 15% of the fund in it. On dips, I would look to buy more, but I think we will get them. Indian analysts tend to be overly optimistic, and this is your snail trails of forecasts. They do tend to trend down. So it all looks a bit overdone at the moment, but intrinsically we would be looking for disappointments and pullbacks to add to Indian stocks. And that really wraps it up for the fund. So how are we actually positioned? About half the fund is actually in world-class exporters, global leaders. Stocks we think like ResMed or TSMC are in growing segments and have comparative advantages that means they win in a growing segment. That's where I like searching for stocks. That's where, in the 30 years I've been investing, I've always been most successful. So a chunk of the fund, about 25%, in what you would call really, really boring companies, Swire Pacific, Bank of China, Hong Kong, Hang Lung Group. Stocks where we think the share price can do okay, maybe grow in line with nominal GDP, but they're yielding me 5 or 6%. And then we have your Chinese consumption and services. We do still think China will grow, but really only in certain segments. So that's our Macau Gaming, AIA. We do have some Louis Vuitton. And then we've got our financials we've talked about and some of our Indian domestic names where we can just about stomach the valuations. And that's really it. So thank you.
Thank you so much, Robin. Fresh off the plane from